welcome to this week's MFB News. I hope everybody's well and you've had a good fortnight. Sorry for not being here last week. I had a week on the very tropical feeling Norfolk Broads. I was so lucky with the weather. Have to be honest, it wasn't a trip I was particularly excited about, but actually it was absolutely glorious. So a real kind of break from reality, because for those of you who've been on the Norfolk Broads, you will know that the pace of life up there is much slower, so very relaxing. And I'm about to hot foot it this afternoon up to Scotland on the sleeper train. If you want a laugh, have a look at the weather in Portree, because I'm heading over to the Isle of Skye for a couple of nights. And you'll see what I'm facing there. Needless to say, going to be slightly different climate to last week. Now, in terms of what we're going to be covering off for you this week, usual updates on swap rates and lender pricing changes. We're going to be going through the latest Mortgage Works buy-to-let barometer, just to kind of give you a sense about where landlords' heads are in terms of plans for the future, confidence in the market, all that kind of stuff. Always really good to hear how the landlords are feeling at the moment, to give you a kind of idea about the market. And then finally, we're going to be just touching on house prices, this time according to interpretations from one of the very respected economic reporters in London. Okay, so first up, swap rates, and not huge amounts of change since we last spoke, but that is a good thing actually, because they haven't gone up, and as we know, anything's possible. So as of 10:45 on Monday evening, because it is Tuesday, sorry, I normally record this on a Wednesday, but actually because I'm going up to Scotland, I thought it'd be better if I just did it now, rather than trying to record to you from a sleeper train somewhere in the Highlands. So 2-year swap rates 4.082, 1 month ago 4.337, so circa 0.25% lower than they were 1 month ago. And year on year, actually, this is kind of quite impressive. So 2-year swaps were 5.664, so over like 1.5% lower now than they were compared to 1 year ago. Obviously, this is going to be massively helped by the fact that base rate has come down, because as we know, swap rates are a prediction of what's going to happen with base rate. 1 year ago, things were feeling a lot less comfortable than they do at the moment, and we've seen a base rate reduction and inflation come down and all those kinds of things. So that's going to have really helped us. 5-year swap rates, very similar story. So 3.659 as of last night. 1 month ago, 3.855. So slightly lower step down than the 2-year fixed rates month on month, but a step down nonetheless. And 1 year ago, 5.020. So again, just under 1.5% reduction year on year. So that's really positive. Now, in terms of how this is fed through to the lenders, first of all, well, I mean, I could just go through all of the rate reductions, but there's just been quite, so many of them. So kind of the most notable ones, we've seen rate reductions in the last fortnight from Virgin, BM Solutions have brought their rates down by up to 0.18, Santander down by up to 0.21%, Accord Mortgages down by up to 0.15. In the more specialist end of the market, we've seen Kent Reliance make reductions of up to 0.2%, Foundation of up to 0.25%, Westwood of up to 0.3%, Vida up to 0.4%. That was the biggest step down that I could see. And Paragon have also made some pricing changes as well, and their pricing has become really keen. So the way I would explain it is, if you're looking at limited company lending, the really kind of cheap lenders, the lenders who offer the lowest interest rates, who are also the most fussy, are the Mortgage Works and Leeds. Paragon are now pricing kind of in line with those guys, and Paragon can do a lot of the stuff that these guys simply won't touch. So that's really great to see. Now, in terms of criteria changes, we've only seen one big change in the last couple of weeks, and this comes from Hampshire Trust Bank. Now, Hampshire Trust are very much a specialist lender, so they're really looking at sort of complex investment deals, semi-commercial as well. They're very good at, and they have loads of niche strings to their bow. So, for example, they can lend to someone who's non-UK resident, non-UK national, so a foreign national living overseas. As an example, that's very unusual. So lots of great stuff in their criteria. Now, what they've done is they've enhanced things a little bit further. So the first thing is, for first-time landlords, there is no longer any restriction on loan size or assets. So, for example, you could buy your first buy-to-let, which is a 20-bedroom HMO, for £2 million. Now, there is no other lender who will come close to this, okay? So there are lenders who, for first-time landlords, can do HMOs, smaller ones, and they kind of restrict the loan amounts. But actually, Hampshire Trust have literally just said, we're taking off all the restrictions. First-time landlords, we're ready to help you, which is fantastic. Like for like remortgages, so when you remortgage and you're not raising any money above the amount that you owe your existing lender, they're now actually stressing the rental calculation at the pay rate on 2-year fixed rates. And this is quite normal on 5-year fixed rates, but actually in the world of 2-year fixed rates, lenders are a bit more restricted. Hampshire Trust are now stressing at a better pay rate on 2-year fixes. And also what they say is for blocks where there are 12 units or less, all flats are 30 square metres above. The valuer confirms all units can be sold individually within the last 12 months, and an aggregate valuation can be used. So just to kind of unwind that one a little bit. So what we find is if we take a freehold, which consists of multiple self-contained units to a lender, for smaller ones, so generally up to 4, they're going to say, okay, well, if we took the value of each individual unit, if they were to be sold separately and tot that up, that's going to be the value. So the value is the sum of the parts. But anything more than 4, and it can be actually lower than that, some lenders, even if it's 2, what they do is they give what's called a block valuation. And this generally means that the valuation would be the sum of all the parts less around 20%. And it does vary, it can be less, kind of more like 10 to 15, and it could be greater, but there is going to be a reduction. Now this tends to be a problem for those people who have built or redeveloped a building into a block of flats, and they're looking to leverage their financing as aggressively as possible. So they want to get the most amount of money out of the property, which means they're going to need the highest valuation possible. So if we take it to a lender who's going to use a block value, obviously you immediately wipe off, let's say 15% of the valuation, which can have a huge impact in terms of borrowing capacities. So what Hampshire Trust is saying here is that if there's less than 12 units and all flats are greater than 30 square metres, then they can actually essentially work on the basis that the valuation will be the sum of the parts, which is very, very unique. That's a very, very long way of explaining something there, but I just thought it was probably worth digging into. So I think in summary, in terms of the mortgage market over the last 2 weeks, all really positive. So pricing reductions from some really key players, some big lenders there, and not insignificant reductions. Swap rates are holding firm. We had the news about inflation, where inflation had increased slightly to 2.2%. That's actually lower than people were forecasting, so that's also really good. So I think in the round, yeah, a good couple of weeks. Okay, now a quick dive into the latest buy-to-let barometer, which is published by the Mortgage Works. Now, a bit of potted history here. So the Mortgage Works quarterly release various reports on the market, which I always find really fascinating. It's very good of them. They spend a fortune commissioning some kind of market research company to go out and survey thousands of landlords, and they come back and put everything back together in a nice little graph, and I get to kind of share it with you, which is very good. So thank you to the Mortgage Works. Now, in terms of reporting on this, so it's actually largely quite great news, actually. So they're talking about, first of all, landlord confidence. So they kind of measure 3 different things within the market. So rental yields, the confidence in own letting business, and confidence around capital gains. And of these 3 metrics, the number of landlords, or percentage of landlords who are coming back with the wording good, they're feeling good about these things, has increased across all 3. So in terms of rental yields, so 36% of landlords are saying that they feel good about rental yields. That's compared to 33% this time last year. In terms of prospects for their own letting business, 37% are feeling good about this, compared to 22% this time last year. In terms of capital gains, 19% of you were feeling good about this, compared to 18% of last year. Now, I appreciate the last one is a very, very small increase, but it is an increase. In the previous year, it would have been a massive decrease. So, you know, let's be pleased around that. But I think the kind of overarching sense we can take away from this is that landlords are feeling much more positive about the future, about their business, than they were 12 months ago. Now, conversely to that, one of the things this report reports on, could I say report more times in one sentence, is the number of landlords who are planning to sell in the next 12 months and the number of landlords who are planning to buy. Now, 11% of respondents are intending to buy in the next 12 months, but 33% were planning to sell. So what we can see here is that if that were to kind of come to fruition, that means a step down in the number of properties in the private rental sector, which, as we know, the market sector is so stretched anyway, that wouldn't be a good thing. So let's hope these guys who are planning on selling hang on in there and change their minds. And I think actually with interest rates coming down, rental yields are still increasing. The private rental sector is still very, very strong, performing very, very well from an investor's perspective. Perhaps when it comes to actually selling, these landlords may actually change their minds. Now, the last thing they talk about is rental increases. So how many landlords have been increasing their rents? Now, I think actually over the last few years where the trend of rentals, rental income has been increasing, rents have been going up, I think most landlords have been increasing their rents at some point or another. However, what's been really interesting is that the last, or this quarter compared to all the previous same quarters in other years, has seen a fairly marked increase. So in quarter two 2024, 74% of landlords have increased their rents in the last 12 months, I should hasten to add. In the previous year, it was 65%. In the year before that, it was 57%. Go back to 2021, it was 26%. And in 2020, it was just 21%. So what we can see is that actually year on year, for the last 3 years, over half of landlords have increased their rents in the last 12 months. So really just kind of testament to the fact that, and this is nothing we don't already know, that rents are still continuing to increase. Now here at MFB, we love an economic report, and one I read recently was very much talking about house prices. So I wanted to share this with you. It is a little bit data heavy, as you'd expect from an economic report, but it makes really interesting reading. So I'll kind of try and make it as numeric and data heavy as I can. So the ONS official measure of house prices has risen by 3% since December in seasonally adjusted terms, leaving prices almost bang in line with the recent peak in September 22. So essentially, the ONS is saying that house prices have increased by 3%, and so any kind of loss that we experience when house prices took a downturn has been recovered. The ONS provides only non-seasonally adjusted data prior to 2005. On that basis, the 1989 crash, for those of you who are old enough to remember that, I'm sure most of you aren't, took over 88 months to recover. So when we had the crash in 89, it took 88 months to recover. By contrast, house prices in non-seasonally adjusted terms would have recovered all the losses since their 2022 peak within 24 months if they continue to rise at half the average month-to-month pace seen so far this year. This house price correction has been remarkably short in a historical context. So I think really what we can see here is that actually what has gone on is that there's been no lack of desire for people to buy homes, to move homes, to upsize, downsize, whatever it is they've been looking to do. But the appetite has always been there. It's always been about concerns over interest rates and affordability, and also restrictions on lending. That's not going to help things either. So I think actually as time has gone on and people have become more confident, people have had pay rises, we've seen inflation slow down and get back to kind of where it should be, interest rates peaking and starting to ease it off again, confidence has really returned to the market, and people have gone out and started transacting with houses again. And that's been a really kind of quick thing. It was always a sort of timing issue more than anything else. And actually the report goes on to kind of further underpin this, which obviously makes me feel really good, because therefore I should be an economist. The short housing downturn has taken place despite interest rates remaining high and even rising as the housing market recovered. The average interest rate on a 2-year fixed rate mortgage with a loan to value of 75%, and this is on homeowner stuff now, rose from 4.71% in January to 5.19% in May. Even just modest falls in interest rates should boost house prices. Moreover, and this is kind of the important bit, I think, forward-looking surveys are pointing to house price inflation accelerating. RICS reports the rise in new buyer inquiries matched or outstripped the rise in sellers for only the second time in 26 months in July. So essentially, in July, there were more people looking to buy or making inquiries about buying than there were people looking to sell. So it comes back to this supply and demand issue that we seem to kind of just keep going around in circles with our sort of slightly broken housing market at the moment. So still, low unemployment supported by strong business confidence and rising consumer optimism are supporting the market. The majority of, major purchases index of the July GfK Consumer Confidence Survey reached its highest since January 2022, and the Future Activity Index in the PMI is booming. So essentially what they're saying is that confidence has really come back to the consumer market. People are looking to the future and feeling much more positive. The report goes on to say that we expect real household disposable incomes to rise each quarter by 0.4% on average this year, and the unemployment rate to peak at 4.6% in H2 2024, which we've kind of already been through. Combined with the MPC fanning the flames of rate cut expectations, we expect year-over-year house prices rises to accelerate to 4% by quarter 4, up from 3% in our last Housing Monitor. So essentially what they're saying is that actually by Q4 of this year, they're going to be expecting house prices to increase by 4%. We're expecting to see people have more disposable income as well, which is really, really positive. So hallelujah to all of that. Why is this important? This is important because if you are thinking about buying a property and you're one of those people who's been kind of sitting back and very calmly just watching the market and seeing how things are shaking out, and I know I've said this before, but genuinely it really does look like the house prices have reached the bottom and they're really starting to turn around. And therefore, if you are thinking about investing, it feels like now is probably a very, very opportune time. Right, that's it from me this week. Thank you, as always, for having a watch or listen. I hope you found it helpful, and I'll be back next week if I haven't drowned in the thunderstorms that I'm going to be experiencing in Scotland. Have an amazing week. Enjoy the weather here in England, if that's where you're based. I think it's going to be a lot nicer, and think of me when you're in your gardens having lovely barbecues. If you have any questions, the office is fully running over the summer, so 0345 345 6788, or have a look at our website where there's always lots of wonderful information. I shall see you again same time next week. Until then, take care of yourselves.